One thing that I'm exploring is that equity markets, and I emphasize the word equity markets, are literally suffering from selective hearing, and they only see what they want to see, which is the reopening narrative and none of the political angst that there is around the world. Do you think we're suffering from selective hearing? Sorry, the set's just gone a magnificent shade of red, but we'll deal with that. Christophe, good morning. Selective hearing?
Yes, good morning. So regarding equity markets, the response to the economic policies is very strong and selective. Strong because since the trough, equity markets recovered a lot. Afterwards, year to date, we are in positive territory for the Nasdaq, meaning that from the selection point of view, market selection point of view, I would say the first winners are clearly the disruptive, innovative companies. Most of them are listed within the Nasdaq, and this is why the Nasdaq is so strong. As I mentioned, year to date, the performance is now positive at +7%, outperforming very strongly the European markets, for example, with a performance year to date at -17 on average. As you know, within European markets, there's not so much disruptive, innovative companies, and this is why European markets are underperforming so much the US market. So we have two selectivity within markets, which is theme, first, innovative, disruptive companies, and second, geography. US outperforms the rest of equity markets on the planet.
Christophe, actually, we had one of our opinion piece writers saying that the current rally is about 10 weeks old, but it may have already taken as history's most hated. But what we are seeing as of last Tuesday, short positions are starting to build. We're seeing the biggest build in 5 years. Do you think that investors are starting to maybe take on some of those concerns and at least give themselves a little bit of a hedge?
Yeah, the problem that most investors face too are, I would say, twofold. The first one, most of investors are not overloaded in equities, and they are surprised by the strong reaction in the equity markets, as we were discussing 2 minutes ago. And second, people don't understand why markets are so strong despite rising risks around us. And the risks takes different shape. We have, for example, presidential elections in the US, putting at risk the economic policy adopted by the Trump administration since a few years. If, for example, tax cuts could be replaced by tax hikes, corporate tax hikes, in case of, for example, Democrats winning for the next US election. We have also new tensions between US and China. The trade war is back in the game just after the deconfinement measures. And we have also rising risk in the sense that afterwards the economic recovery is a soft one. We don't expect a V shape. We expect a U shape, if not an asymmetric U shape, because we had a contraction, very sharp contraction, in just 1 quarter. And then it will take quarters, probably 2 years, to come back to the pre-crisis level. And people don't understand, investors don't understand why markets are so strong despite all this risk we are mentioning: economic risk, political risk, geostrategical risk.